we've heard this since really like the beginning of the pandemic when home prices started to rise. They really rise violently and put some people off because they couldn't make that down payment. And now the discussion's still continuing because of now it's mortgage rates. Whereas before it was just simple home prices. Now it's mortgage rates and also the fact that home prices really haven't gone down in a way that would compensate for the increased interest rates, which that's a lot of the same thing happening in the multifamily market. But we have also been, just as much as we've been talking about these barriers to home ownership, we've talked about the disconnect between home prices and rents. Redfin used to have a useful comparison, but that kind of fell off. And there were other sources that were actually from a very early point in the recession. They were starting to track this, and this has been a discussion really ever since home prices started taking off in earnest around the end of 2020.
Well, it kind of flies counter to the narrative, which in both things are true, are that the rent's just too high. Rents are way too expensive, and the rents need to come down. But then when you look at into relative to the whole universe and housing market, what are your alternatives? Rents actually seem relatively cheap, but again, try telling that to anybody who's running an apartment, especially last year. That doesn't seem very cheap, even with rent growth, negative year over year. It's 1% negative over 20, 30, 40% increase from a couple of years ago.
Yeah, that's true. People haven't really yet forgotten those previous increases, and it's still on an absolute basis, really, really high. And just looking at the history is pretty persuasive to see that we are in a period in which home prices are so much more expensive than rents. But that being said, I was curious a little bit about how they got this number. And the common thing, I know it's a little bit of a caveat, but I think that the graph that's supplied in Wall Street Journal, that's more persuasive than what I'm about to say, which is to say that yes, you can tell that it's highly abnormal. However you formulate it, we are entering a period in which home prices have never been more expensive relative to rents. Now, the way they figure this is a little bit tricky because they are combining median home prices with an average apartment unit rent. Now, the average apartment unit is not 3 bedrooms, and a median home is 3 bedrooms, 3.38 or something like that. But so if you kind of equal it, so the median home square footage is 2273. That's as of 2021. The average apartment unit square footage for a 3 bedroom is 1367. So it's about 60% the size of a home, of a single family home. So roughly speaking, apartments are 39.9% smaller. But in my formulation, then compared to the median mortgage cost, which was $3,200, the median rent is $2,100. So I did the math there. If you're equaling out, the comparable apartment is 39.9% smaller, but it's only 33.5% cheaper.
Okay.
If you but that does not factor in the maintenance costs and just the other is kind of upkeep and the amenities. And there's a lot of other things that make, maybe usable space, convenience. There's a bunch of other stuff associated with it.
So not apples to apples comparison.
Not exactly.
Not pure, but the general sense and the takeaway is true. Doesn't necessarily, because you're saying on one hand, it's okay, you get in a smaller space in an apartment, so that makes sense. But at the same time, there's a lot of costs associated with owning it.
And what the Wall Street Journal, by factoring this in over time, what they have said is, depending on where that equilibrium, we're well off of it. Maybe there is a premium to being able to move out in either way.
They're taking the same statistic, or they're using the same metrics over time. It's also relative. So again, so the formula, it's like looking at unemployment. It's okay, we can agree that the U6 or whichever method of measuring unemployment is maybe flawed, but if we're using the same measure, it can be at least relative, until
if you see the big increase in that line graph, then something's unusual.
It's still unemployment may be higher, but it's lower than it was at this point when we're measuring the same thing.
And also what I really thought was really interesting, and it made me want to expand this even further into the past, this chart we have of the difference between home prices and rents is that there's definite periods periods in which, things were more expensive or things were cheaper if you were a renter. So from 96 till the end of 2002, buying a home was cheaper than renting in their formulation. And then from 2003 to 2010, renting was cheaper. It's a great housing crisis, and it, it kind of reared its ugly head. And then from 2010 to 2020, outside of 2 quarters in 2018 where renting was cheaper, for those 10 years, it was cheaper to buy a home than it was to rent. And there's, the effects of the downturn in home prices. Again, there's some ups and downs in 2020 and 2021, but the definitive trend happens at the start of 2022, where homeownership goes from -1% cheaper than renting all the way up to 20% more expensive. We've had 2 years, according to the data in the CBRE article, where rents are cheaper. And the span of time, previous was 10 years where homes were cheaper. Now rents are cheaper. And then the last time that rents were cheaper, they had 7 years where rents were cheaper.
When I see this graph, man, it's interesting. I think with a couple of things. One, there's a lot of 2006 references that we're finding today.
Yeah.
Whether that is the previous all-time spread between cap rates and the 10-year Treasury, which is in 2006. 2006 in general was, peak real estate prices, before the great financial crisis.
Yeah.
And so it kind of makes sense. Also, at a period of where, according to this chart, apartments were the most expensive, were at the least amount of discount. In fact, what made more sense to buy rather than rent was a great time buying apartments.
Yeah.
So, it shows it's not necessarily, one, that it's affordability, but it's also demand. There is so much demand for single family homes right now because of millennials, because of this Freddie Mac article we're talking about later.
Apartment rents were cheaper in 2006.
Yeah.
And then it was still a great time. But
you would not want to have been buying in 2006.
Yeah.
So you could look at this.
Point,
I'm just taking the same data, and in one perspective, you could say, wow, this is great for apartments now, but it's really not. It's good for apartments in a couple of years from now, once we get through whatever we're going to get through over the next year or two. Because again, and then that's when the demand gets turned on, when the supply across all housing declines because of some sort of recession or tight lending standards like we're seeing today. We're going to see a slowdown in deliveries, man, in 2025, 2006, 25, 26. And so it's a very similar situation I can see rolling out of where, housing prices are peaking. And then if, a recession happens or whatever it may be, when the switch gets flipped over, folks are starting to rent in more apartments because they don't think it's a good idea to buy a home for whatever reason. That's when we start seeing the rent growth in apartments because the demand has increased, but we haven't built any new apartments.
Yeah.
So it's, again, we're setting up the stage for, some distress in the near term and some really good buying opportunities, probably within the next 6 to 12 to 18 months, because there's going to be a really good environment for rent growth and operations in 2025 and onward. Most likely. Again, that's like a little bit of crystal balling, but that's how I see this as setting up really good long-term fundamentals. But right now, today, it's showing because rent growth has stalled. Values for apartments are down 20%. Single-family homes are up.
Yeah. Well, and that's kind of what I was thinking about is the lagging effects. Now you can kind of trace interest rates as maybe a cause of some of this. There was a brief bump in 2018 that could have been caused by the taper tantrum or something like that. But ultimately, I think of it in this way, in that, yes, home prices are that much higher. It does not mean that you're guaranteed that rents are going to go up. But I think what it does is give you some insulation. And we see this in the pandemic where apartment rents did not crash like home prices did. And really the story of it being cheaper to buy a home during that time post-crisis is because rents just stayed stable. They didn't just decrease, but it was
decline in
home price.
home prices went down. Exactly. Yep.
So there is just this fundamental stability, and I don't think it's born of owners and operators and landlords saying, "Oh, I don't want to push it too far." Like, they will push it as far as they can. That's just what they're going to do to make as much money as they can. I mean, and it's not like an evil thing, but I think that it is a product maybe of the fact that there is just more price discovery going on at any one moment in the renter. So there's, you have 100 units in one location, and you could kind of suss out what the price is rather than waiting to sell one single it just seems like a more of a leveling effect.
You have you're more investors as owners rather than owner occupants. A lot of corporations own single family homes, but that's not really what we're talking about. Still generally the vast majority of single family homes are purchased by individuals and families, and so there's just they're still thinking through an economic sense. They have to be able to afford to do it. It has to make sense. They have to get underwritten by a bank, but that there's less of it's not less return driven. And just less analytical, and just the decisions to buy and sell again are less driven by economics. They can be, but it's more kind of lifestyle and life event.